Welcome back, guys, to a new episode about value investing and a question on multi-baggers. So, which stock is the next multi-bagger? That's a common question. That's a very common question that comes up every day. People want to chase the next multi-baggers. So, let's explore and dig deep into it. So we don't predict multi-baggers. We don't predict the price. All we can control is the business that we value. If we value the business at the right price and buy it at the right price and hold on to it with patience, then we would be able to benefit. That is the bottom line. Whatever I'm going to say after this is going to make it clear about multi-baggers and the myth that surrounds it. So your earnings and cash flow gets you what you need, the business returns. What you need is business returns. If you can predict the business returns with good amount of certainty and probability, that is where you gain. That is what you should look at. So let's look into it and see how we can identify the right business so that our returns are magnified, although we cannot predict that. So what changes the business returns? What drives business returns? That's the question you need to ask. If someone tells you they're buying a multi-bagger today, ask them about the business. What drives their business? So I can give you one example. Let's take an automobile company. The automobile company is able to sell A-class cars that we call mini segment, hatchback, small cars that you see around you. Some of those have thin margins. Not so thin, but relatively thin when you compare them to other segments, sedan, C segment, for example. So let's assume they make 15,000 rupees for each car. This is just an assumption here. So we'll take a number here and look at it. So let's take an example. Let's get into an auto business and see how the margins can make a difference. So when you talk about margins, let's dig deeper and say there is an A segment car which sells with a margin of say 15,000 rupees, while their higher segment, B segment, the premium hatchbacks, they have a margin of 50,000 rupees. Now let's assume they are able to sell more of the B segment or maybe even C segment cars, and their A segment cars are getting replaced by B or C segment cars. Now that's exactly what's happening if you look at the reality in the past few years. Their first car is usually people get their A segment car, that would be their first car. Today, tell me what is the first car that people buy? It's usually the B segment or C segment. Although the A segment has been dominating, their growth is downward. They are declining. There's no growth in those segments. This growth is actually in the C segment and B segment, especially the B segment, the premium hatchbacks. So if you assume that the margin goes from 15,000 to 50,000 and their volume, let's assume, is the same, meaning the A segment cars are being replaced by the C segment or B segment cars. Now the volume is not going up, but the margins are going up pretty steeply. That's an example. If you can predict that with good amount of certainty and the price is right when you buy the stock, that is where you make real returns, and that would be a multi-bagger in hindsight. But that's not what we're chasing. What we're chasing is the business, and remember that, instill that pretty hard in your heart. Make it deeper. We are looking at business income, business cash flow, business earnings. The other probability is saving taxes. There are ways where you can save taxes. SEZ, for example, you enter into SEZ, Special Economic Zone, you get some tax breaks. There are tax holidays for small companies. These are ways where we can save on taxes. Usually these perks are available for a reason. And if you can satisfy those reasons, you get the tax breaks, the tax advantage. That's good. That's possible. Another possibility is to increase your utilization. Let me take the automobile sector again, make it easier. A lot of car manufacturing companies have capacity. They can produce more cars in those existing plants. They don't need to expand. They have the capability to produce more cars with the existing capacity. But that is something that prevents them. Each company has a problem. So that is the reason why the utilization is usually around 40-45%, except a few companies which are in the high 80s and 90s. So those are possibilities. If you feel those 40% utilization is going to go to 80 or 90% in the next few years, that is a business earnings where you don't spend anything, or maybe you spend a little bit, probably to refurbish your plant and machineries and run an additional shift. Those are the additional expense, but you still can make more out of them, more out of those assets. That is what we need. So what else can drive your earnings and cash? More reinvestment, more return on equity and ROCE. How do you do that? You can do with number of ways. You can put everything back into your business, try to get into more opportunities. That's something that every company does. If you can make a biscuit, you can make a cake. So if you feel that there is a market, you do a top-down analysis and a bottom-up analysis. And you see whether they can actually capture a large market. And if that is a large market, then that is where you can really grow. Another opportunity is mergers and acquisitions. If you are able to get hold of a company at a good price, you make money. But be cautious here. The problem here is most companies, they pay too much to buy another company. That is where you get into trouble. Do you need to do that? Think about it. You need to know exactly what the company is doing. You need to know how much they're paying, whether the price is right. So that is very, very important. If you can get to that, you make money. But that is a risky business. So you need to have good amount of knowledge to be able to play that game. So be cautious on that. So let's wrap up. Some final checklists. So questions you need to ask. Can you increase your margins? If you can't do that, can you increase the volume significantly, keeping the existing margins intact? Let's say you find something that is a luxury item today and it is going to become an affordable product in the near future. So that's an example where your necessity plays out. A luxury item, select few, can now be at the reach of every common man. For example, cars in the US, United States usually is not a luxury item. You need a car to drive around if you're in the suburbs. You really can't survive on public transport except for a few cities. You can't really survive without a car. It's a bare necessity in the suburbs. In India, that's not the case. People consider it a luxury item even today. If you feel that's going to change, That's an opportunity. But you should be able to find that at the right time, because if you're too early, you are losing opportunity cost. If you are a little late, you miss out everything. So another possibility is on companies which depend on raw materials. Let's say they heavily depend on certain raw materials. Those are examples where today it could be a different story, but if you feel tomorrow the raw materials will go down, it's at the peak today, but it can't sustain, it's going to go down, and you are able to ascertain that, then that is an opportunity. That is an opportunity where you are able to identify raw material changes, and these companies are heavily dependent on certain raw materials. For example, the tire industry heavily depends on raw material. If you can figure out what's going on with the raw materials, and if you are early, you can make a real benefit in identifying those companies. So we did see a lot of options where we can find multi-baggers, but that's the business that you want to look at. A final reminder, it's the business. Be very cautious and make sure you look at the business valuation and not the price charts and price flows. And until another episode, thank you for watching my channel, and don't forget to subscribe to the channel by clicking the bell icon below.